Hi, I am Paul Diggle, Chief Economist at Aberdeen. Welcome to our February monthly macro outlook video. Geopolitical risk has been a key theme for investors so far in 2026. So let's think through how persistently elevated geopolitical risk will impact markets and portfolios over the long run. Starting with the big picture, geopolitical risk is structurally elevated because of some deep underlying changes in the international order. The rise of China as a peer competitor to the US has meant the end of the unipolar moment and the return to great power competition. Economic interdependence, which was previously a stabilizing force in international relations, is now being weaponized. Technological change, including AI, is an arena of geoeconomic contestation. Global institutions are fraying and less able to stabilize the interaction between nations, and developments such as climate pressures, migration flows, rogue actors, and heightened domestic political instability are all at work too. These factors are collectively pushing geopolitical risk permanently higher. The chart on the left, which plots a news-based geopolitical risk index, is one way to show this. And the chart on the right is a nice demonstration that some of the world's most critical maritime choke points, essential to global supply chains, the Strait of Hormuz, Suez Canal, the Taiwan Strait, sit in geopolitically fraught locations. One important market implication of all this is that inflation volatility is likely to be permanently higher. Geopolitical shocks that push up on commodity prices and supply chain reductions that reduce the supply of key inputs will mean higher and more volatile inflation. This is in stark contrast to the 2000s and 2010s, when the challenge was often of too low rather than too high inflation. On the left-hand chart, we show that even as inflation has normalized after the pandemic, the volatility of inflation remains elevated. Investors need to prioritize inflation protection in their portfolios. A key consequence is what's happening at the long end of global bond markets, shown on the right. More inflation volatility alongside fiscal pressures has seen long-dated government bond yields move higher. Investors need to factor in steeper yield curves and higher bond term premia. Another major implication of higher geopolitical risk is the changing behavior of asset class correlations. The left-hand chart on this slide decomposes the recent inflation overshoot and shows the substantial supply-driven component. Supply shocks, which come from geopolitics, supply chain disruptions, and even climate-related disruption, tend to push growth down and inflation up. So crucially, they push bonds and equities in the same direction. That's exactly what the right-hand chart here shows. US 10-year bond yields and the S&P 500 are showing more frequent episodes of positive correlation. And this marks a regime shift from the period when bonds were a reliable hedge for equities. Investors will need new sources of diversification, such as alternatives, commodities, and real assets. Traditional 60-40 portfolios are not going to provide diversification in this new world. The next big implication is that investors will likely keep questioning the status of dollar assets, at least at the margin. The US is one of the sources of much of this geopolitical risk, from tariffs to the Don Roe Doctrine to intervention in the Middle East. There are legitimate concerns about the stability of US institutions, and there is a risk of US control of the dollar financial system being weaponized. And all that will keep encouraging diversification beyond dollar assets. The big gold rally, shown on the left, has in part been driven by central banks diversifying reserve holdings away from dollars. And of course, many dollar assets, particularly equities, are historically expensive. All this is why the Aberdeen House view has a general preference for emerging market assets over those of developed markets. That said, dollar dominance is not ending. The chart on the right shows that dollars are still the overwhelmingly largest currency in global foreign exchange reserves. For markets, though, even small changes in these preferences influence pricing. Another important consequence of higher geopolitical risk is the big increase in defense spending. The left-hand chart shows announced increases in defense expenditure across NATO countries, from the old target of 2% of GDP towards the new all-in target of 5% of GDP. The right-hand visual outlines the scale of capability gaps in Europe in particular, around air defense, artillery, drones, cyber, intelligence, and AI integration. Closing these gaps requires a multi-year fiscal commitment, and their spending will likely be deficit financed, adding to the upward pressure on bond supply and sovereign yields, but also creating company-level investment opportunities. The final investment implication of higher geopolitical risk I want to mention is the global scramble for critical minerals, the need for supply chain security, and the push for investment in dual-use infrastructure. The left-hand chart highlights China's dominance in critical minerals refining and processing, with the US responding by sourcing more from Latin America. The right-hand chart shows our estimates of the vast infrastructure investment needed across both developed and emerging markets in coming decades, particularly in transport, electricity systems to support the energy transition and resilience. With government balance sheets constrained, there will be a big role for private capital in funding this build-out at the intersection of industrial policy, national security, and supply chain resilience. Thanks for watching. Please reach out to the economics team here at Aberdeen if you'd like to dig deeper into any of these themes. And as always, good luck out there.